In this mini lesson, we're going to do something different. Instead of talking about what segregated funds are, we're going to start by talking about what they are not. Now, it may seem odd to introduce segregated funds in this way, but trust me, there is a method to our madness. You see, students often confuse segregated funds, which are also referred to as seg funds, with other types of products that share similarities. Early on, students learn these 4 things about a seg fund. It's a product sold by insurance companies. It's an insurance contract. In other words, it's a contract with an insurance company. It can offer potential death benefits. And finally, it allows you to name a beneficiary who will be entitled to the death benefit. With these features in mind, it's common for students to think that seg funds are a type of life insurance policy. But in reality, the two are very different. Life insurance is a product where a policyholder could, in theory, pay a single monthly premium of, say, $200, and if they died shortly afterwards, their surviving spouse could receive a very large death benefit, perhaps hundreds of thousands of dollars. This outcome isn't possible with a segregated fund. The following will serve as a good visual memory aid. SeeWhy trainers were asked, is a segregated fund more like an investment or an insurance policy? And the survey says, an investment. It's critical that you keep this in mind when learning about segregated funds. Let's explore why. Sally and Jacob Smith are married and have a newborn daughter named Gracie. Jacob is a sole income provider and earns $50,000 per year. Sally stays home to care for Gracie full-time. They both worry about what would happen to their family if Jacob passed away unexpectedly and his income stopped. Sally wouldn't be able to care for Gracie if she had to return to work. On the other hand, if Sally passed away, Jacob would have to pay for full-time daycare and keep working. Life insurance could be the solution to both of these risks. The Smiths have allocated $200 per month to address the risks of Jacob dying. They're considering 2 options. Number 1, buy a life insurance policy on Jacob's life with a $200 monthly premium. And number 2, invest $200 per month into a segregated fund. Let's discuss what would happen under both of these options if Jacob died 1 month later. First, let's see what would happen if they bought a life insurance policy on Jacob's life. Let's assume that based on his age and the type of policy he selected, he was able to buy a life insurance policy with a face value of coverage of $1 million. As beneficiary, Sally would receive a tax-free lump sum death benefit of $1 million upon Jacob's death. Once Sally receives a death benefit, she could do whatever she wanted with the money. For example, if she decided to invest it and received a 5% annual return, this would generate $50,000 in annual income indefinitely, calculated as follows. $1 million times 5% annual return equals $50,000 in investment income per year. Under this scenario, Jacob's income would be totally replaced. Now let's assume that instead of buying a life insurance policy, Jacob invested $200 per month into a segregated fund. Now I can appreciate that you may not yet know what a segregated fund is, since we'll cover that in the next video. For now, just take note it's an investment that guarantees a minimum of 75% of the principal invested upon the annuitant's death or upon the contract maturity date. Let's assume that Jacob selected a fund that offered the maximum guarantee of 100%. Now that Jacob has died, as beneficiary, Sally would receive the greater of the following 2 amounts. The market value, which after only a month will be in the ballpark of $200, or 100% of the principal being $200. This won't be enough to support Sally and Gracie. As you can see, if the Smiths invested into a segregated fund because they thought it was a life insurance policy, that would be a real problem. Unlike a life insurance policy that could provide an instant estate, $1 million in our scenario, the most a segregated fund can provide is the amount invested plus any of the growth. We'll explore segregated funds more closely in the upcoming videos, but the main takeaway from this lesson is simple. A segregated fund should not be thought of as a life insurance policy, but rather a type of investment. If you have this concept under your belt, mission accomplished. While segregated funds were not the right product to address the Smiths' concerns, that doesn't mean that life insurance is better than segregated funds. They are simply very different products that address very different financial concerns. As you will learn in future videos, a segregated fund could be an excellent way to save for retirement, a child's education, or whatever your long-term goals happen to be.